What is going on, guys? It is Jordan de Jong here, and today we're going to jump into the July 2020 Corelogics report. It's going to be a pretty interesting time moving forward. We're going to have very segmented markets. Melbourne is about to go on to lockdown for another 6 weeks as of tonight. So going to be pretty interesting to see how Sydney compares to Melbourne over that period. And the Corelogics data says to be, 2 to 3 months behind, behind what's actually happening in the market. So I don't think we're going to see what is going to happen over the next couple of months until a couple of months further on from that. But it's still going to be very interesting to see how those markets are segmented, because I work for a company in Sydney, but I live in Melbourne, and essentially, the company in Sydney, the confidence is gone straight back up again. Business is good, consumer confidence is back up, all that sort of stuff. But being on the ground in Melbourne, I can feel like, everyone's sort of gone back into hiding, back into being, restricted and confined and not being able to move around and run their business and have restaurants and go out for dinner and all that sort of stuff we love to do on a day-to-day basis. So it's going to be very interesting to see the new data coming forward. I think today is going to be pretty interesting because I'm going to start to see some of the real impacts of the start of the coronavirus, because it is delayed quite significantly. But yeah, it's gonna be interesting to see how we sit today. Before we jump into the report though, I was speaking to my wife the other day, and she has been reviewing my videos, and she says she loves these videos where I'm just talking as a conversation rather than the kind of scripted, in your face, detailed information. I wanna know what you guys think. I'm kind of tossed between the two, because I like the scripted one because just pumps information. Because there's so much information I want to talk about, I find it really hard to not do a prolonged video with all the information. So I kind of pump it and script it and make sure that everything's kind of on key. But if you guys prefer this sort of conversational type of video, just let me know down in the description section below. I'd love your feedback, and then I can sort of mix and match what works moving forward. But anyway, before we go any further, let's jump into the report. So essentially, first chart pack's normal. This is the July 2020 chart pack. No major movement here. Real estate is still a $7.1 trillion industry, and we own $1.48 trillion in outstanding mortgage debt. What is interesting, and I always talk about this sort of stuff, it's a low LVR and all that sort of stuff, but I was reading a book the other day, and it was alluding to, 30% of the market own their house outright, and 30%, I was like 30% out there own their house outright, 30% are in mortgage debt, and 30% are renting of the market or something like that. But essentially there was 30% of the market that didn't own their house outright and had mortgage debt. So don't quote me on any of these figures, but it's good to know that $1.84 trillion of outstanding mortgage debt might only be segmented to 30 or 40% of the market overall. I find it really interesting, although we have got that sort of low LVR of 1.84 trillion compared to 7.1 trillion in actual real terms, and if you put that together with commercial, it's 8 trillion or 8.1 trillion, and only that amount of outstanding mortgage debt, which means we've got a kind of a lower LVR of say 25-30%. Nationally, that debt only does sit with 30% of individuals. So that's a good correlation to have. It's not like the whole market, 25% of Australia. We've got a 25% LVR around Australia, and we're going to be fine. It's that's actually segmented into only 30% of the market. So pretty cool, pretty interesting. I will actually get the real figures on that and maybe do a video on it. But yeah, I think that's pretty interesting, considering I always bang on about having a low LVR nationally on this view. The quarterly change in national dwelling values was negative 0.8%, led by a negative 1.1% decline across the capital city market. So quarterly change here, we're seeing us head back down into that zero or negative territory. The black or the dark blue line is combined capitals, the light blue line is the rest of state. So the capitals are really driving here, and if we look on the right hand side, it's really Melbourne at a negative 2.3%. That's driving this downturn, which is really interesting to see that Sydney's only, doing a little bit, not too much. What I do find really interesting though is, these numbers aren't significant. I mean, we've been in the coronavirus since March, and all these people talking about 30% property crashes, and it's going to end in September. When the stimulus ends in September, we're going to see massive crashes again. And I can't see it. We're already seeing the government come out saying that they are going to extend the job seeker. The announcement's going to be made on the 23rd of July. They have already extended mortgage repayment holidays for another 4 months. So, I think everyone's in this together, and I think, we're trying to get out of it together. I just can't see, all of the regulators and the government not stepping in and helping out the housing sector. Like it's such a big part of the Australian economy. There's really 3 pillars of the Australian economy. One of them is mining and exports to China. Another is construction, and the third is real estate. And real estate and construction are tied so closely together. Even on the first page here, it says residential real estate underpins Australia's wealth. And that is so true. Like when you think about how big the real estate sector is, it's just phenomenal to see how many jobs and how much, when demand in property and construction goes up, all of these jobs come with it. And so when it goes down, so does the jobs. There's less required jobs, and it just underpins Australia's economy. It's so true. So I just can't see the regulators letting the market crash by 30-40%. I just can't see it. That's my opinion only, obviously not financial advice, but that's just how I feel in my opinion about it. So page 4 here, the COVID-19 downturn came at a time when most markets were experiencing strong upward momentum, which is reflected in the annual growth rates. Annual growth rates here. We were looking at the quarterly growth rates beforehand. Now we're looking at the annual growth rates, and we really can't see, that negative amount too much here, because when you look at how it's done over the last year, like Melbourne and Sydney are both up more than 10%, and we've only seen a decline of 2%. It's phenomenal to see that, we're still being okay. And, I think, this COVID-19 is going to have a long-term impact. It's not gonna, we're not gonna see sort of that decline straight away. We might see it taper off further into 2021, and see how, the job losses and the mortgage stress starts to come in after, a prolonged period. It just depends how big, if we do see like a sort of V-shaped recovery in the economy, if people get their jobs back and, unemployment comes down and inflation, starts to pick up again and all that sort of stuff. I think, we'll be relatively good. We would have built that bridge to get to the other side. But yeah, I just can't, with all the stimulus and the continuous extended stimulus that's coming through, I don't think that they're going to stop anytime soon, even if we all went into lockdown for another 12 months. I just can't see, the RBA has stated that they'll continue to support the Australian government in any way they can. That, they've already printed a whole bunch of money, and they essentially said that there's no cap to how much they're going to print to stimulate the economy, or give it to the government to stimulate the economy. So, I just can't see it. I can see certain sectors getting hit pretty hard, and that would be the high-rise apartment market. I think that will get hit pretty hard, especially with all the Airbnbs and all that sort of stuff. We are seeing rental listings come down now, so that's another challenging statement. But yeah, I think, and they've always been the issue. They've always been the markets that have been impacted the most. They've always been the markets that we've seen, a negative growth in, or negative equity, and people, buying them off the plan at the peak of the market in 2017, and then trying to get finance when they were built in 2018 and not being able to. So I think the other markets are going to get impacted the most. The rate of decline over the June quarter has been more significant across the upper quartile value properties in Sydney and Melbourne. So essentially what we're seeing there is the bigger, larger, expensive properties leading the negative growth there. And essentially what's happening there is, the larger mortgages, the bigger repayments, these CEOs of big companies that have now closed down and lost their jobs, and they can't make those bigger repayments anymore. They're the ones that are getting hit quite harder, and probably selling, fear-mongering selling, selling out of the property because they can't afford to hold on to them, or they can't afford to rent them out. There's only a certain demand for people who can rent out $2, $3, $4 million properties. There's only a limited amount of segmented of people that can, and although there's always other people that can rent them out, we're in a harsh economy, and everyone's sort of second guessing their jobs and second guessing their positions in their companies, regardless of how long they've been in them and how high they are up. things can change overnight, as we've seen throughout this whole COVID period, and there are plenty of people in financial hardship. So whether that's 100% of what's driving the market, or all we can see there is the upper 75th quartile is the bigger picture there of the negative 3.7%, and Sydney's driving it with a negative 1.3%. So pretty interesting to see. Recent price declines amid COVID-19 have started to materialize in lower annual growth rates across Sydney and Melbourne. Annual change in dwelling values on the left-hand side for Sydney, Melbourne, Brisbane, and Adelaide. So yeah, again, we're seeing it on an annualized basis there. Melbourne is the one that is coming down much quicker than Sydney, but essentially it's the same graph as we saw before. We've got Hobart on the right-hand side. We've got Hobart and ACT in the plus zone still. With Darwin and Perth still in the negative, and on the left hand side, Adelaide and Brisbane are still doing in the positive zone for an annual change. So not too bad there. Only 2 markets that are in the negative position, and they have been since 2014. So yeah, pretty interesting to see there. And so this big bounce back recovery was so interesting to see. The APRA shut down, yeah. So now we'll see how far they come down. It's funny how, what impacts the property market. Access to credit, which was what was happening in 2017, and how much of a downturn that happened. And now we're in the middle of a global health pandemic, and what you'd think would be so much more significant in terms of the economy, because of all the stimulus that's come in, it hasn't been as significant. So it's really interesting to see the market drivers and what really does have a big impact. So the rolling 28-day change in the home value index in combined capitals is down negative 0.8%. So we're still in the negative on the daily change there, and we have been since sort of mid-May, start of June, probably mid-May. The Corelogics Daily Home Value Index showed a change of pace halfway through March. Data to July 1st shows the combined capital cities declined by 0.8% in the past 28 days. So yeah, still on the decline trend there. There's no real indication. I mean, it has kind of been slowing down over the recent days, but over a 28-day period, it's too hard to see any indication there. No real U-turn or flatline or coming back up again there. So yeah, interesting to see that it's still on the decline though. Quarterly and annual change in Sydney. So quarterly change there and annual change. Annual change is only taking a little bit of a hit. Quarterly change is now heading into negative territory, as we just seen beforehand. Melbourne, same scenario here, taking more of a little bit hit on the annual basis, down into the negative territory there for the quarterly change, and becoming much more significant than the previous months. So yeah, going to be interesting to see that trend moving forward. Brisbane is just hitting down into the negative zone now, so pretty strong in the previous quarters. No real impact on the annual change just yet, but there's a little bit of a decline there. June, back still in the positive. Sorry, not June. Adelaide. Adelaide's still in the positive zone, as we can see there. No real impact on the annual change. It's still heading upwards, but they did fall negative 0.2% over June. So no impact on the quarterly change there. So Perth, big change in the quarterly change there. They were down negative 1.1% in June and 2.5% in the quarter. So big of a hit in the quarterly view there. It's a shame because they were just starting to come out of that big negative period at the start of this year, but obviously taking a bit of a hit here. Hobart is still positive, which is great to see. I think they're pretty much, don't quote me if I'm wrong, but they're coronavirus free. Like, they don't have any cases, I don't think. So good to see them back up in the positive territory, or still in the positive territory, and even higher than the previous quarter, which is great to see. They even increased by 0.3% in June, which is awesome. Darwin, up the same, 0.3 in June, and an increase in the quarter of 0.4%. So not seeing as big of a quarter increase as last two or three months, but still in the positive zone there, which is great to see. ACT increased 0.1% in June, so minor increase in the last month. However, we're up 0.7% in the quarter, which is great to see. They're still in that positive territory there. All right, monthly sales with 6 months moving average national. Yeah, so we're seeing some massive jumps up here in the light blue line. That must be 6 month moving average. Yeah, okay, and that's the decade average. Yeah, okay, and that must be quarters. So the light blue must be quarters. The dark blue must be 6 month moving average, and then that straight line there is the decade average. So although we are below the decade average, it's not taken a significant hit. On the right-hand side, it says Corelogics estimates that the national settled sales bounced back remarkably over May and June, increasing further 29.5% over the month. Wow, that's crazy. Change in sales volumes for the select periods. Change in sales volume March to April and April to June. Wow, so see that sales volumes negative is huge March to April, which was when the pandemic first hit and was pretty significant. And then on the right-hand side here, we're seeing the change in volumes have increased pretty significantly, and we can see that the same volumes have increased by 59% in Melbourne. So that's what I'm saying. It's going to be interesting to see how different the Sydney to Melbourne data is going to be over the next 6 months. I'm probably not going to see that for a while, but next 6 weeks, given the 6 week lockdown, I think they're going to be quite different, which will be interesting to see. Consumer sentiment recorded to pre-COVID levels in June, which is awesome, which has supported a recovery in sales volumes over the month. Yeah, so consumer confidence is essentially, people who, just the confidence level of individuals about the market and how they feel and what their sentiment is. So big negative decline there at the start. That was kind of what everyone was reporting on it. I did a big blog on it and everything else, and it's kind of like, wow, consumer confidence gone out the window. Like everyone has no faith in the property market anymore. But essentially that's bounced back to pre-COVID levels, which is really good to see. Really good to see the bounce back and the confidence. And we can even see periods here of massive declines, bit of a lull, and then push back up again, which is really cool to see. And we can sort of see the trend and the correlation between the two. The monthly sales kind of does follow that consumer confidence level with that kick up back here and then the recovery up here. But this has been counterintuitive. The monthly sales hasn't come up as quickly as consumer confidence has, but I think we'll start to see that play out over the next couple of months. Growth in national rent values was 0.7% in the year to June. However, rent values are still negative 0.5% lower than the recent peak in March. So seeing a bit of a slowdown in the rental rates there. SQM did just release the statistics for rental markets, and don't quote me if I am wrong, but I think it was about, it peaked in May 2020. So May 2020 was like 115,000 rental listings on the market, and May 2019 was something like 95,000 or 97,000 or something like that. So massive difference there. It was a difference of 15.8%. So heaps of listings on the market. However, in June, I think it was the week of the 26th in June, there was less rental listings on the market in June 2020 than there was in June 2019. So the rental market has filled up. There's forecasted to be lower vacancy rates over the coming months, and we're seeing less listings on the market, which is really good to see. It's starting to normalize. Haven't seen a massive decline here in the rental rates, which is also great to see. And I think that rental market will start to stabilize now. I still think there's probably a lot of Airbnbs on the market that are either going to transition back or be listed on the market. I think that's going to be a bigger space and a bigger problem, especially in those major CBD hubs, apartment buildings, and that's why I keep saying those high rises, multiple apartments, hundreds of apartments in the same complex are the ones that are going to get hit the hardest. If they're 40% renters, 40% Airbnbs, and a couple of owner occupiers, like they're the ones that are going to get hit the hardest if the property market something happens to it. All of those investors are going to want to sell. The Airbnbs are going to either try and rent them out normally and then realize that every other Airbnb host is doing the same sort of thing, and then potentially sell as well. So you'll have, in a block of 100 units, you might have 70 of them all in the market at the same time. Can you imagine that? Probably not that dramatic, but essentially that's the supply. When there's an oversupply of thing, the price comes down, supply and demand, and that's where people are saying the pain points are. Not only that, a lot of them were built in that sort of peak in 2017 and sold at the peak of that 2017 and are already in negative equity. So I think we're going to see a lot of pain and a lot of stories come out from that sort of segment. And I think, it's going to be great for our generation that haven't, are watching this and haven't bought into that, because I think it's really going to distill what an A-grade investment is, and they'll understand that, growing up, all I was taught that, you can't lose in property. For 30 years, the property market has just grown and compounded over time. And, I think one of the biggest things to take away is that you can actually lose in property. You can actually invest in the wrong asset and it won't perform over time. So, I think people are going to become more aware of it's not just as safe as houses. Not every asset is created equally, and some assets do depreciate or see negative equity over time. Rental yields have come down to 3.73% over June off the back of a negative 0.3% decline in rent values across Australia. So gross rental yields national, see a bit of a pump up there in late 2019, and now we're back down to 3.73% in June 20, which is really interesting to see. Not a massive decline there. So gross rental yields still in that positive 3.4, 3.9 sort of area. So nothing major to see here. Combined regionals is 4.9%, which is quite high. But yeah, as you can see, the Melbourne and Sydney market have much lower yields due to higher property prices. So they're only at sort of the 3.2 and 2.9 level, which is really interesting to see, and that's just price driven. They're going to have lower rental yields because the cost of living for someone to rent out those types of properties isn't going to be viable, and that's why a lot of people do the rent investing strategy. A lot of people rent those more expensive properties. The $1 million, $2 million properties. They rent them out because they can rent them out cheaper than their mortgages are. Maybe not in today's cash rate environment, but essentially that's the plan, and then they invest in these properties with high yields and high potential to grow in value. That's the rent investing play. Homes are taking longer to sell, with national median number of days on market rising from 43 days over the March quarter to 45 days over the June quarter. So taking longer to sell, that's pretty interesting to see. Not a massive change there, like it's only 2 days over the time, but we can see a bigger pickup from sort of the start of June there, and that was essentially when the coronavirus came through. Not the start of June, but sort of March, start of 2020, I was meant to say. So they are on market for longer, not to the same peaks as we were sort of seeing in the mid 2018s, or late 2018, I should say, but still 57 days on market for combined regionals and 41 days for combined capitals. So normal auction campaign is 30 days, so it's not too bad when you're considering the whole scheme of things. And then they're breaking down into the minor markets here. Who has the longest day on market? It is Perth and Darwin, and the shortest is Hobart. So properties in Hobart are selling quite quickly. Interesting. Over the June quarter, vendor discounting started to deepen. The median vendor discount was 4.4% nationally, down from 4.3% in the March quarter. So getting a little bit deeper there. They're starting to see bigger discounts come through. Nothing too dramatic, 0.1%, which is interesting to see. I think this will be interesting to see sort of over the next 12 months how deep vendor discounting does become, especially after sort of that the government stimulus rolls out, after the extended 4-month period and mortgage holiday, and job seeker, job keeper, how long they're prolonged for, and all that sort of stuff too. This will be an interesting to watch, I think, one to watch moving forward. New listings have increased significantly over June. As of July 5th, new listings have increased 44.3% from a low in early May. So early May, essentially that whole decline from mid-March to early May, the market was shut down. You couldn't hold an auction, you couldn't hold open homes. The market essentially stopped, and so that's why we sort of saw listings come pretty dramatically off the market, and we see how they trend. Compared to other years, they do start to come off in that period and that season anyway. So. Although there's a much bigger decline than usual, we are starting to see listings come up. What is interesting is now, it's nearly at the same level as it was in 2019. And if it keeps going on this projectile, we're going to have a lot of stock on market. But what we are seeing is people still buying homes. So although listings coming onto the market have increased significantly. It all depends on how many people are actually buying those properties, like that supply and demand level. Like if there's more stock coming on market but more people buying properties, then it's pretty relative. Where if there's more properties come on market and no one's buying, then that's when we have that surplus of listings on the market, and we start to see vendor discounting come down pretty significantly, and houses getting sold for a bigger discount there. Yeah, so pretty interesting to see that trend moving forward. I think it's going to be interesting to see how the rest of the year plays out. However, high sales volumes means that total listings have continued to trend down and are 15.8% lower than the recent peak in mid-March. Yeah, so essentially it's the same thing I was just talking about before, because there's higher sales happening. Even though there's so many more listings coming on the market, there's higher sales, and it's keeping that total listings line flat, which is pretty cool to see. Obviously, it's pretty significantly lower than the previous years, but we are going through a health pandemic, so it's expected. But interesting to watch this in the next couple of months as well, because if this starts to go up, then we're starting to see those supply and demand levels uneven, but currently they're quite similar. I think it's mostly a lot of people are trying to snap up a bargain, or trying to get a property for a lower price. A lot of first home buyers and all that trying to get in, and I think that demand is really coming from a lot of people getting grants and incentives and all that sort of stuff, and lowest interest rates that they've ever had, which means they've got an increased borrowing capacity, which means they can buy more, have more to spend, all that sort of stuff. So it's pretty interesting to see. New listings have now climbed 6.9% on the equivalent period from last year across the combined capitals. Combined regional areas still have a relatively low level of new listings from the same period in 2019. So new listings changed from equivalent period last year. Yeah, okay, so we are seeing some negative there, apart from Sydney and Melbourne are up that sort of 18.1 and 24.8 respectively in growth. And then on the very right hand side, we've got total listings changed from equivalent period last year. So yeah, pretty down significantly there, which is interesting. I would like to see that number come up, but a lot less stock on market compared to the same time last year. As auction volume started to recover, the combined capital cities auction clearance rate average of 58.9% over June. Weekly clearance rates and auction volumes combined capital cities, yeah. So this is pretty interesting. Obviously, that big V-shaped recovery has been nice. The bottom of that was essentially when there was a ban on auctions. You couldn't hold an auction, so obviously you're not going to have a high clearance rate if you can't hold an auction. No one was going to auctions, no one was bidding auctions, everyone was staying at home and terrified that the pandemic was taking over. They're all buying toilet paper, but that has bounced back, and although it's not as high as it was previously, 58.9% is still pretty relatively low. That's kind of a neutral market. I think what they say is it's a buyer's market if the clearance rate's below 54%, and it's a seller's market if it's above 64% or something like that. Something in between those ranges. So pretty neutral market there, in between. No one's really sure about what's going on. No one's going crazy and buying millions of properties, but other listings are stabilized too, so vendors aren't going, I've got to sell my property, I've got to get it on the market. So pretty interesting mix there. Over May, dwelling approvals declined 16.4% month on month to the lowest level since January 2013. So on the left-hand side here, we've got monthly number of dwellings approved for construction, nationally and seasonally adjusted, which has come down pretty significantly for units, and has come down a little bit for houses. As expected, total number of units was getting pretty out of hand there, sort of May 2017, which caused that APRA slowdown, or them to put in some regulation there. But yeah, interesting to see the units have come down pretty significantly, and houses aren't, they're not at the lowest level they've ever been, but they are starting to come down. So on the right-hand side, I've got monthly dwelling approvals by state seasonally adjusted. So we're comparing April versus May here. May has come down in pretty much all states. Yeah, all states have come down with a dwelling approvals there. So that's interesting. I think I think the numbers in June will be higher because of the home builder grant that's come through. So I think it actually will be very interesting to see what June comes out with a home builder, because from what I've heard with the media and everything, like apparently most of the major builders have had the best month that they've ever had. So I think it's going to be really interesting to see the dwelling approvals come through here in the next month. Monthly value of new finance commitments total on the left-hand side. So investors have taken a big plunge since, 2015, 2016. Owner occupiers are still on the way up though. So even though they're coming down for a little of a ride now, they're still up pretty high. I think that's, sort of 14 billion there, 13 to 14 billion, where investors is only, back down to sort of 5 billion now. So interesting to see investors are coming down continuously. Portion of new lending for investment housing excluding refinance. So yeah, taking a big plunge there. I don't know what that middle line is. Must be the national or the average there of 36.5%. But yeah, it's down now to 26.2%. So yeah, only 26% of loans are for investment housing. Very interesting. Not a big portion of the market. Definitely not as big as we were seeing sort of 2014, which was 45%. Nearly half of the market was for investment purchases. Interesting. New home lending among investors fell 4.8% over April, while owner-occupier lending fell 5%. Oh, okay, owner-occupier was falling faster than investor lending. Interesting. It is worth noting that finance data is lagged, and the sharp decline in lending may reflect the low sales volumes seen over April. Yeah, okay. Again, data is lagged here, so it'll be interesting to see in a couple of months' time how this all sort of panned out mid-pandemic. The latest lending data shows the share of first home buyer lending at its highest since December 2011. Yeah, so and that's what I feel like. I feel like it's the perfect time for first home buyers to try and get in and try and have that sort of pause, that slowdown in the market, and not be bidding against investors at auctions and have a chance to sort of get in with all the grants and all that sort of stuff that's happening at the moment. Highest it's ever been since December 2011, and that is just phenomenal. Especially with all the home builder and all that sort of stuff that's coming through. So super interesting to see. Northern Territory there, home builders are 43.1% of the market, the share of buyer lending. That's huge. Australia-wide, it's 30%. New South Wales, 27%, and Victoria's 34%, which is a bigger markets there. But yeah, the ranging at that sort of 30% there of first home buyers coming in. Over April, investor participation declined in every state except Victoria and the Northern Territory. Come on, Victoria. Yeah, so interesting to see investors have significantly come down since sort of, what's interesting there? So Queensland, South Australia, and WA have had a declining trend since April 2010. We had a peak for both New South Wales and Victoria, around 2014, 2015 there, and it has been coming down ever since. So pretty interesting to see that the portion of investor participation is continuously coming down. Australia-wide, it's only 26%. Victoria is 27%. New South Wales is 29%. So crazy. The cash rate target was held at its record low through July. The RBA have reported the actual cash rate has recently traded even lower than its target. So yeah, even though the cash rate hasn't changed at all, there's still banks bringing down interest rates and all that sort of stuff happening behind the scenes. So although this remains the same, and I still think we're going to see it stagnate at this level for quite some time, it's definitely not going to go up until employment comes back down to 4%. That's what the RBA has stated. Whether it will come down below 0.25%, I know plenty of people who think that it will, but yeah, I think the way that the banks are operating and trading and reducing their interest rates and all that sort of stuff, maybe they're doing their own thing until it does come down. So I don't think it's like a forced thing that needs to happen anytime dramatically soon, especially with interest rates being on pause and freezes and all that sort of stuff. Average new loan rates generally declined in May, but the rate of decline slowed compared to the rate falls in April. So generally declined. Still seeing a big difference of 42 basis points here between owner-occupier and investor premiums, which is no good. I'd like to see that come much closer together, but still on that decline there, still coming lower. yeah, no major change really from the previous months that I can really recall. Yeah, so pretty interesting there. I think that sums it up. Yep. Yeah, so that is it, guys. Once again, thank you so much for joining me today. Really interesting insights and some good data starting to come through. I think over the next couple of months, we're going to see some even more shocking data come through. And that's simply just because of the ban on auctions and all that sort of stuff. And I think that, you know, because there's such a delay, we won't start to see that come through for the next couple of months. But once again, guys, if you do love this content, make sure you subscribe, smash the like button, hit the notification bell, do all those good things. And you know, if you do enjoy this content, share it with some of your friends, share it with people that you know, people who you think may be interested in it with. I love it. All helps to grow my channel and get the support and the word out there. So yeah, thanks again, guys, for watching, and until next time, happy house hunting.